What's up, YouTube? We've got a lot of things to talk about today, and I'm in a pretty serious mood because some of the stuff that's been going on is really insulting to our intelligence collectively. And what I'm talking about is how the government has been cooking the books, and they're cooking up some fine stew over here at Ponzi Investments. And it really caused the market to take a swan dive on Friday, basically when the employment data came out. Now, the employment data came out on Friday, and it was under than what was expected. It was around 100,000 was what was expected, and it came out to be around 70,000. But that wasn't really the big news. And a lot of people were wondering, well, why did the market tank on Friday? It had actually been going down on Thursday, but they're saying, well, the tariffs kicked in on August 1, but it was really the cooking of the books that tanked the markets. And let me explain to you why. Because what has been going on is the jobs data initially comes out with these stellar numbers. The markets go up when they come out. Economy's looking strong. This time it actually came lower than expected. Like I said, it was supposed to be 100,000. But then what happens is for every month they revise it down, and then they revise it down again. So this is not just one, but two revisions for each month. 228 to 120,000. That's 108,000 difference from the original number that was reported on that caused the markets to go up. And so they have been basically putting out numbers that are, way optimistic. And then when nobody's looking later on, they revise it downwards, not just once, but twice, right? And the last two revisions were huge, right? We're talking about 250,000 jobs just vanished in a thin air in the past 2 months. That is a huge problem. But let me be very clear here. It's not the first time that the government is doing this. And that's what really is annoying. This has been going on for a long time. In fact, last year during Joe Biden's administration, the entirety of last year was revised downward by almost 1 million jobs. Over 800,000 jobs were revised downwards last year, following the same pattern. But this is really bad because the last 2 months, this is just a shocking revision downwards. And let me show what that actually looks like to you in a chart, because you can't really see it in a tabular format. Now, somebody posted this on our Discord channel, and thanks for posting it, but I just wanted to share with all the YouTube folks out here. This outline is what they originally reported, and the revision downwards is solid. So it was revised. That just shows you visually how much the past 2 months was revised down. And, this July number of 70,000, I bet you that thing's going to get revised down again. Now, you might be wondering, well, if this has been going on all the time, why is all of a sudden the stock market surprised? Or why is it, matter anymore to the stock market if it's been going on all the time? The market shouldn't care about it, right? It's become accustomed to this type of nefarious activity. And the answer is, just this Friday's job release, it came in under, It came in under the expectation by quite a lot, right? It was supposed to be 100,000-ish. It came in 70,000-ish. That's 30% under. That's a huge miss. And so that opened the door for everybody to start wondering what was going on. Are we really going, is the economy softening? Are we going into a recession? And with a double whammy of the job revisions downward at the same time. So the trigger was a huge miss in the jobs report. Now, what happened in previous months and the other revisions was that the jobs number always beat the estimate, right? So even if there was a revision update to the prior months, it was okay because, well, the current month beat the estimate, so everything's looking hunky-dory, and nobody really cares about the revisions from the earlier months because this month it's looking good. And that is, you see how stupid it is? It's really stupid. But that's basically why all of a sudden it started to matter on Friday, where the revisions on top of it were huge, right? 250,000 in 2 months is also by and of itself quite a big number. But if you combine those two things together, that was the recipe for the market tanking on Friday, basically worried about, are there are the chances of us going into recession higher than what was priced in? And the GDP numbers came out also or recently, right? It was a shocking upward 3%. Remember, it went down last time, right? Q1. Q2 was up 3%. So everyone's like, wow, economy's doing really well. But you have to remember, the reason why it was negative in Q1 was because a lot of companies bought forth a lot of, supply before the tariffs came about in order to prepare and stock up so they wouldn't get hit with high prices. And that imbalance in the amount of forward future borrowing and buying a lot of imports ahead of time caused the GDP to go negative. And it was revised negative further from negative 0.25 to negative 0.5 because of very softer than expected consumer discretionary spending, which means the consumer is faltering. So the converse just happened, right? Now that they're not buying as much because they already front-loaded all the imports from the pre-tariff days, the reverse happened, which is the GDP all of a sudden spiked up, which you would think is a really good thing, but it's not, because it's just, again, the inverse of what happened earlier. So that's one type of, if you want to call it, imbalance or, I guess, dislocation in the data. But there's others, right? You probably are going to hear about the first time here on this video, and because that's what we talk about in this. We don't talk about the usual stuff you see everywhere else. We like to talk about stuff that's kind of proprietary or very unknown of or lesser known. And since I have such a small YouTube channel, it's good, right? Because only a few of us will know about it, and we can take advantage of that information in the future. But one of them is with CPI. And if you look at this, right, a few people have talked about it. Most people don't know about this. There's this thing that the government tracks, right? The BLS, the same folks that come out with, the jobs numbers. By the way, Trump came out and fired the lady running those jobs numbers, saying that, well, and in this case, he's right? He should have been fired before. And who knows the data? Like, is the data now right and it was wrong before? Is the data wrong before and now right? Who knows, right? But that's the problem. If you have bad data, nobody knows what to trust. We always say, like, oh, the Chinese are cooking the books. Yeah. Well, in CPI world, the BLS has this metric which they track, which is they call it the different cell imputation, right? Share of uncollected prices imputed from different geographies or items. In other words, there's items for which somehow the BLS, they don't know what the price is. Right? And they have no choice but to just guesstimate the price. In other words, and then that's the price. Okay? And that has generally been around 10% in the past decade, if you go further, right? But somehow, right, in just this year, around when tariffs started, this has shot up to over 30%, approaching 40%. 40% is almost like half. In other words, almost half the prices that they use to calculate the CPI is done this way. I mean, it's kind of subjective. They can put in a number and kind of explain it away. In other words, they can target a CPI and compute backwards. Now, what is this telling you? Remember, these are the same guys that have been cooking the jobs numbers, right? Well, the viewers of this channel will know this CPI numbers are cooked up as well, perhaps even more than the jobs numbers. And that means the CPI is probably a lot higher than they're telling you. Just like the jobs data is a lot worse than they've been telling you. So knowing this, right, and understanding this type of, what's coming down in the future, you've got slowing, right, employment. You got what's likely increasing inflation and a slowing consumer discretionary spending going down. Look what's going on with Vegas, right? If you look at what's going on with Vegas, a little side note here, is all the casinos in the Strip are losing money. They are toasted. And they're not even getting saved by the conference, because usually Vegas relies, when the consumer gets soft, they rely on conventions and conferences, because that's corporate money and they don't care about your hotel fees, right? They'll just pay the crazy amount, right? And charge it as a business expense. But conventions, right, and conferences, not saving Vegas, right? It was like negative 10% this month, for the month of July that I saw. And so where the one part where the casinos are making money in Vegas is in the suburbs, right? That's like record amounts of money for those casinos, and the most they've ever made. And what is that telling you? People go to gamble. Number one, they're not going to the Strip, right? And where do they go? The degenerates who have to gamble, and they just need to because they're addicted. They go to the cheap places, out in the burbs. That's another signal, right? You got to be able to see these signals. And Vegas is a good leading indicator, because gambling is one of the first things, you kind of do less of when your money's going off, right? And you're tightening the pockets. So that means basically, right, you got, again, putting it together, you got employment softening, you've got prices rising. These two, they're cooking the books, right? But the truth's gonna come out. Then you've got consumer softening, discretionary, as a result, right? So what does that tell you? That means we are heading into stagflation, right? Jerome Powell doesn't want to cut rates because he's scared of inflation. Now the employment data is a lot worse than we thought it was. We might be going to a recession. Normally cut rates with it. But if you cut rates, the CPI is higher than we think, then you're going to have inflation. So something's got to give. You can't save both, right? You can't save both. And this is why it's a problem, right? Basically for the economy, right? And nobody wants, this Fed doesn't want stagflation. In the worst case, they have to control inflation. The economy's going to suffer. That's what they had to do in the 70s, right? Because they can't let the system blow up. Now, moving along. So the stock markets, let's talk about stock markets. Stock markets just did a swan dive, right? On Thursday and then on Friday. So 2 days of just relentless selling, right? And this purple line I have here is a very important line. We kind of bounced around here on Friday, and we ended somewhere around here, right? And so the question is, what's going to happen? Well, let me tell you what I'm thinking. First of all, understand that this, look at that, right? That is a huge gap right at the top. It made an all-time high and had a big bearish engulfing candle, then followed by a huge gap and another big red candle. This is a very bearish looking sign. So this does not look like it's going to just go up like this, right? At this stage, it's very clear now. We're probably going to correct somewhere here. We might have a correction go back down, but we are going to have some kind of a correction here. This kind of a topping with a huge gap like that in the middle of two big red candles at the all-time highs is a very big trend reversal on really high volume as well, right? Take note of the volume. And so, watch out, right? But I think for better context here, let's look at the NASDAQ. That's a S&P or SPY, but same thing on the NASDAQ, right? Big bar, big gap. But, if you look at the NASDAQ, when did we have that kind of like a top, right? That happened around here, right? Where we had this run up, and then big down, big gap, and just continued down, bounce up, and then more, right? We had that. Where was it? That was last August, right? And that was a scary time. A quick drop. I was around the yen carry trade, if you guys remember what happened back then. We could be looking at a pretty serious correction, given that we just went up without any correction since April over here. And I've been telling you that snapback's going to be just as violent as a snap upward. And trust me, it is, right? And look, we're beginning to see what that means in terms of price action. Now you can say like we kind of had that over here, right? Another all-time high and a big gap, and then we just shot. But the difference there is we had a very gappy rise up, like gap. So we had to fill those gaps and come up. We didn't have all that gappy rise up. It was more like this, right? It was just a churn upwards without any correction. So that's what I think is coming down the pipeline. And it also has to do with seasonality. So while again, I say seasonality is not something that you can bank on, it's good to know what the seasonality is, because that's first of all what everybody else is looking at, and sometimes that becomes a self-reinforcing reality, even though it doesn't guarantee anything. And it also lets you know in the past, in history, like what kind of happened every month. And while, like I said in my earlier video, you can't look at that like a roulette gambling table and just because it's been read all the time it's going to be read again. No, you can't do that. You got to factor it in at least, because other people are thinking that, and other people impact how the ball is going to land, right? Unlike in a casino where the ball's always 50-50. And if you look at seasonality, it is that August begins the downturn, right, in the year, with September being a very not good time of the year, right? And so that's something to keep in mind. We just started August. Looking at it from a graphical point of view, not a bar chart, you can see that this is kind of what happens, right? And we're about to enter this period. Now, if you look at, actually, we kind of tracked the seasonality pretty well this year, except for this huge downturn, which is caused by Liberation Day, which I guess is an anomaly over here, but we kind of recovered and followed through. And so, if people act because they think this is going to happen, and that becomes a self-fulfilling prophecy, then this could happen, right? Just for that reason. But one thing to take a look at, which is a derivative of price action, kind of, which is the VIX, or the volatility index, and look at that seasonality, you can see that it too has, unsurprisingly, a period in August, but all the way to October where it maxes out, right? And we just came down. This huge spike up here was, again, the Liberation Day, but we kind of tracked it as well. So if seasonality and self-reinforcing prophecy happens, you would expect us to have a pretty choppy next 2 to 3 months, I would say, after we had just done nothing but rise up from the April lows. Now, one of the members in the Discord channel was asking me, like, hey, technical analysis, should we look at these patterns and, how good are they? Look, if you're trading off of this, sayonara, man. I mean, purely off of this, you're getting toast. The truth is, technical analysis and pattern matching and this type of stuff, once upon a time, okay, long time ago, it actually worked, meaning like it made sense back then, because this was before we had computers and the internet and fax machines, and people were doing stuff in pencil and paper. Remember, you got to remember, stock market's been around for a long time, right? Back in those days, people would find these patterns and trade around it, because the pattern was a representation of herd behavior, basically, right? And nobody else you can share it. It wasn't real time, so it actually worked, because it was kind of new back then. Not everybody knew the pattern. But the moment the pattern became a known thing, and basically everybody knew what the pattern is or was, and it loses its value, right? And today, with the internet, with everybody trading, everybody like social media, copy paste, everybody knows what the pattern is. So essentially, not only did the patterns kind of like lose their value, but they actually became a negative thing, meaning like they were used as a way to scam you by the sharks. So they would make things look a certain way, right? And the market movers with big volume could do that in order to lull basically the retail traders into looking at this stuff and getting mesmerized by it, and then pulling the rug on them and having the chart pattern break in the opposite direction. So, when people ask me like, hey, you're a technical trader, or you look at chart, well, technical doesn't mean just patterns, right? Technical means market internals in terms of different measurements of overbought conditions or oversold conditions and so on and so forth. That has nothing to do with patterns. But even with patterns, and yes, I do look at patterns, I don't like patterns that everybody knows of, right? To me, they're very dangerous, and I try to shy away from them. I don't short them, because that's also dangerous, meaning bet the opposite of what the pattern does. But I don't follow the patterns, because it's something that everybody knows, and it's actually something that the sharks use, right, to pull the rug on people. And so why am I bringing this up? Well, one of the things I wanted to show was this pattern. And this is okay, so this, where's the descending wedge here? There's got to be a descending wedge somewhere here, right? What? Reversal, falling wedge. Okay, there's it's not a complete list here, but I guess the closest one is this, the falling wedge, or another version of this is the descending wedge, where even the bottom one is not horizontal, it's also going down, but it's going down at a much less steep angle than the you know the the trend line above. And in that it would also break out and go just like a falling wedge, right? So if you look at that, you'll see this. And this, we had a falling wedge here, and it broke out, and it met kind of like where it should go, right, which is the beginning of the wedge. And similarly, we have a falling wedge here. You would expect the breakout to go at least to where the wedge began over here, perhaps a little higher, or who knows, right? But at least we would expect this massive move up. And I'm following this pattern. If I just told you, like, I don't follow like a falling wedge, I mean, falling wedge, descending wedge, everybody knows that pattern. Why would I follow it? Well, the answer is not everybody's looking at this chart. And what is this chart? This is the S&P. This is the SPY, right? But it's an inverted S&P, okay? It's an inverted S&P. Now, how many people do you know look at the inverted S&P 500 index all the time? I'm sure not many of you, maybe none of you. About 1,000 people watch this, maybe none of you, maybe a handful, but not a lot, right? Which is the whole reason why I follow this. See, again, if not many people are looking at the same, I don't mind telling this to you because I only have 1,000 people watching this, so I'm not going to make a dent in anything here. But the whole point here is not many people watching this, right? So the pattern still has value. You see what I mean here? Okay. This is some of the stuff that I'll tell you that other people are not showing you. Probably won't see this in any other place. But if you find ways to look at data, right, that other people aren't looking at, it's okay to use the patterns because nobody's looking at it, right? And so here I expect this to go up. So what does that mean? And this going up means the S&P is going to go down because this is obviously the inverse. Now, will it go down all the way to the April low? Falling wedge wouldn't say that it does, right? So maybe we correct until around here, right? And then maybe we make all time. We'll talk about what I think is going to happen. But anyway, that's the little thing I wanted to share, a little tidbit for those who happen to be watching this about patterns and how to really use them to your advantage. Okay, moving on now. So with the stock market going down, you got to be very careful. Like I've been saying in my past episodes, right? A lot of retail got into the April to now run up in stocks, right? And not only is it retail, but they've been going into options and levered ETFs, meaning they are on margin and margin and margin. And this chart tells you that, right? Leveraged ETF total. Who buys leveraged ETF? Well, not always retail, but a lot of them are. New record, right? ETFs work great on the upside, but when they come crashing down like it did on Friday, steep drops, they're multiplied down. So you're going to get crushed, right, on the way down just as fast as how much you were making on the way up. And this is what I mean when if it goes up like this, it's going to come down just as much, right? And you saw that the last Thursday and Friday. Retail people are also in the options market where you take margins and you double, triple your bet down, right? Or even more. 10x it if you go crazy. Look at this crazy amount, right? Ever since April. We are levered, baby. But you know what happens when it goes down? Your margins go down, and there's something called a margin call. Right? And okay, margin calls not only just for retail people, also for big institutions that took risks or hedge funds that took risks. Now, when the market has a violent downturn like what we saw on Thursday and Friday, those are precipitous drops, right? I showed you in the charts. Those are steep drops. That means you're going to get taking a gut punch, right? And now you got to pay back the margins. Your broker's going to come calling for the margins, right? And usually what happens is they wait for the day to close. So it's the next trading day where you got to pay, right? because it closes at the end of the day for the big asset managers, right? And so that means it's on Monday when you may see some margin calls, right? You just listen to what I said. The margin calls, if there are going to come for those who got hit by that really severe downturn on Friday and Thursday, particularly Friday with a gap down, margin calls might be coming on Monday. And what do you need to do? You need cash, right? And so what happens when you have a margin call? You got to either get liquid, so you got to sell stuff to shore up cash, right? So you might have to sell things that have been making money, including winning assets, winners. That could be gold. That could be anything that's been going up and you had profit. You might have to sell some of that. Get the cash. The cash is in dollars, so that means you need dollars, right? There's going to be a run for dollars. So both gold went up and dollars went down, but we might see the opposite of that when the mechanical action of a margin call because of a collapse in prices due to highly levered positionings may occur. We already saw that happen in 0708, right? Dollar went up, gold went down. Long story, gold was going to go up, obviously, but we had that mechanical cycle that it had to go through before it resumed its activity up. This is what I'm talking about. Is it now and this time? Maybe, maybe not, but it's going to happen when we have the collapse. And I don't think this is the collapse, because the collapse will be sovereign debt. And so that's when you'll see like the whole like, basically the country going broke, right? Countries going broke, like Japan debt, United States. That's when that happens. That's it. That's when. But we might be having a test run of that, right? Absolutely, because we're just way, way overvalued, right? So I'm kind of tired. I'll just showing this again because Bravo's research is it. Well, they had a pretty nice graphic where, it looks like neon lights. They do a pretty good job of the graphic, but we're at all-time highs, right? We're at 2 standard deviations high. The last time we hit it, we had that crash earlier in 2022, and then, we had the dot-com. So we're here again, right? We're here again, right? And are we going to go up here 3-4 standard deviations? I mean, anything's possible, but the probability of it keeps going down when you're that sigma, that you have that much of a sigma move away from the norm, right? And I bring up this chart as well. Like when we start having these swings of moves, you got to understand most of the action happens after the market closes and before the market opens. It's not during the day trading session. There's a member on Discord who's asking like why I care so much about pre-market price activity, because we did gap down on Friday, and I mean, you need to incorporate, because that's where look at this, right? 722% positive versus negative 8.5%. I mean, if you did nothing but just bought at the end of the market and sold at the opening of the market the next day, you'd be making so much rather than holding during the day. Right? So that's another thing I just want to, for the people here who happen to be watching, I mean, throwing you this little nuggets of info you're probably not going to find on other places, but watch. This is why I always watch the futures S&P 500, the ES, right? Even though I don't trade the ES, I use the ES to tell me what's going on all the time, right? All the time. This is one of the reasons why. Now, there's some people who are saying we're going to correct, and this is, these are the Elliott wave people. And I told you, I used to be a big Elliott wave fan 10 years ago. I used to. Anyway, I super hardcore rabbit hole geeked out into Elliott waveness, and I stopped. And I use it time to time to kind of like, so I understand what the Elliott waivers are thinking about, but I don't trade on it anymore because it's just a revisionist. You just keep changing it to fit your narrative, basically, what's happening, right? And a lot of them are saying, and they could be right sometimes, but they're saying like where we are right now in the stock market. Here, let me go back to the stock market. This is NASDAQ, right? Is that we're on a 5 leg up. So this is 1, 2. We finished 3, we're doing 4, and then finally hit 5, right? That's the most basic Elliott wave pattern is a 5 wave move up. 1, 2, 3, 4, 5, and that's it. That's all she wrote, and then you go down, right? And some of the rules are like the top of wave 1, which is this is wave 1, can't intersect with the bottom of wave 4, right? So in other words, the top of wave 1 over here, right? That should be the floor of this wave 4 correction down before we go hit wave 5. Because if you go beneath the top of wave 1, right? If you go underneath that, then this wave count is invalidated and something else is going. This is what I mean. Then you just change it to be what I want. But so that's what a lot of people are looking at, right? So then that means S&P 6,000, right? So I use that to tell me like that's what people are looking at. Okay, that's where we could. So that's a place of interest, right? That I'm telling you. But it doesn't have to be that way, right? Because look, this is not follow like what happened in 07, 08. Did not follow the Elliott wave pattern. It died there, right? Who's to say, right? I don't like this overlaying 1-to-1, right? And I've explained many times before, like I don't like overlays. But who is this? This is the great Martis or somebody on X, right? So, doing this analogy that look at what happened in 07, so this probably is going to happen here. Maybe not, but no one's a fortune teller, and this kind of stuff is just for it gets you thinking and it gets the clicks. Last thing I'll talk about before I finish today's session is gold. So as you know, I sold gold, right? And it's basically, as I expected, done nothing since I sold it. Like I sold it over here and we went up a little and then we came down a lot. And then on Friday, we had a pretty big up day because, well, if we're going to enter a recession with the bad jobs, much worse than expected jobs with the revisions, Fed's going to have to cut rates, which means gold's going to go up due to inflation. So that's the narrative. So the initial move was up, but like I said, if you get margin calls and the equities just keep going down, they're going to have to sell their winning assets, and you're going to have a mechanical situation where gold's just going to have to get sold off so that the managers can make their margin calls, right? And dollars are also going to go up at the same time because they got to shore up dollars and pay off their margin debt. So yes, it was a big day, but we're still in this range of like going nowhere, right? And it's still nowhere. So I got to see are we going to go up here and then are we going to break on top? Like I said, if we do, that's great. I'll just buy in again. I just don't want to be in this stage here because this is a dangerous stage for me after writing it up. I don't know what's going to happen. I don't pretend to know the future. We could go down, right? This could be a resistance going down. I don't know, right? So I'm going to just wait till it tells me what it's doing, right? Until then, I'm just going to sit tight because gold's pretty much not doing anything and sitting tight so far. And so that ends today's session. Let's see what next week's bring. Next week, I think we're going to have maybe a small bounce, but then a resumption further downwards, right? That is the play. That's what I'm looking at. That's probably what's going to happen. Time will tell, but let's see what the market tells us. Having said that, I hope you have a great week. See you in the next episode. Peace.